Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week we're discussing the common misconception that a California entity needs to be dissolved by December 31st to avoid the $800 annual tax from accruing for the following year. We'll be covering everything that happened during the year at Spidell's Federal and California Tax Update. You can choose from live seminar or webinar options, and you can see topics covered and get registered at caltax.com. As of 2006, a business no longer has to dissolve before the end of the year to stop the $800 annual tax from accruing for the following year. However, planning for the tax consequences of the dissolution is still important. The FTB will not assess the $800 minimum franchise tax or $800 annual tax for any business entity for a tax year, specifically for an LLC, corporation, LP, or LLP, if the entity files a timely final tax return on or before the extended due date for the preceding taxable year, does not do business in California after the end of that preceding year, and files a certificate of dissolution, certificate of surrender, or certificate of cancellation with the Secretary of State before the end of the 12-month period beginning with the date the final return was filed. When filing the final year tax return, check the applicable final return box on the first page of the return and write "Final" at the top of the first page. Again, the entity has to cease doing or transacting business in California after the final taxable year to stop additional $800 tax liabilities from being incurred. As an example of the general process, assume the XYZ Corporation closes shop in November 2024. It files a final 2024 return on March 15, 2025, which includes an $800 minimum franchise tax payment for the 2024 tax year. XYZ conducts no business after November 2024, so XYZ will not have to pay an additional $800 tax after it files its 2024 return, even though it doesn't file its dissolution papers with the Secretary of State office until November 2025. For dissolving entities, recommend paying the final year tax preparation fee during the year of dissolution. Many times, the only expenditure after the end of the year is the tax preparation costs. These costs are paid by a shareholder or partner or beneficiary, who can only use it as a miscellaneous itemized deduction, and this generally provides no tax value to the client. By paying the fee early, the client receives a timely deduction and the preparer receives payment earlier. The same will hold true for any expenses that might come due in the following year, like legal fees and cleanup expenses. California does not allow a cash basis taxpayer to accrue deductions into the final year if they weren't paid until the following year. If an entity dissolves prior to filing the final return, remember that the taxable year ends in the month the entity is dissolved, and the final tax returns will be due earlier than the normal due date. For example, a calendar year S corporation that dissolves in October will have an extended filing deadline of July 15th, not September 15th. Dissolving during the month of December will not create a short year. Spidell's California Tax Letter is a monthly newsletter that will ensure both you and your clients are up to date with California tax law changes. You can get subscription details and download a sample issue at caltax.com under Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.